Okay, so why don't we start with because one of probably the biggest question, which I will ask you right here at the get-go, and then we got a visual on this topic, is the one that's I think on almost everybody's mind, which is it over? And when I say it, obviously I mean the correction slash bear market. Do you think it's basically burned itself out?
I'm highly skeptical that this is another terrific buying opportunity, a buy the dip moment, similar to all the ones we've seen over the past 15 years. I think, there's a few things I would point to. One is you could just look at that rally we had last week, that single day 9% rally in the Nasdaq, and it was one of the top three, I think, biggest single day moves in the history of that index. Every single one of the other top five single day moves that we've seen came in the midst of bear markets and didn't come at the lows. So my point is the market always went on to make lower lows from that point. And whether it was early 2001 was another time. I think late 2000, December 2000 and January 2001 were another couple of times where we saw really big single day rallies. Obviously, that was early in the dot-com bust, which went on for another couple of years. The other two single day rallies that were that big were, I believe, in October of 2008, which obviously were in the, post Lehman bankruptcy, really difficult time in the markets. But market went on to make lower lows immediately before rallying into the year end of 2008 and then making, ultimate lows in March of 2009. So I think the message there is pretty clear. We're in the midst of another bear market, and this is a classic bear market rally, right? The famous adage, the strongest rallies come, during bear markets, and I think that was an example that we saw last week. I think the only other thing I would point to is that this is one thing I talk about all the time, and we talked about a year ago. Is insider selling last year was off the charts. We had a 13-week period where the sell to buy ratio went over 50, which is the highest I've ever seen. The 12-month ratio is really the most important one, though, in terms of forecasting the market and the economy going forward. It's literally one of the best leading indicators that I've found of future economic activity, future earnings. And so that extreme bearishness on the part of insiders, essentially, CEOs, CFOs at Fortune 500 companies last year, was a really good indicator that they didn't believe the economy and earnings were going to live up to expectations this year. We've seen kind of a drop off in some selling, but we really haven't seen any insider buying to speak of just yet. I'd really like to see that ratio go below 10. It's still above 20 right now. When it goes below 10, that's a good sign that insiders are stepping back into the market. Their confidence towards over the next 18 months is really rising. And that's usually a good sign for the economy and stock market going forward. And we're just not near that point yet.
Okay, those are great comments, and I appreciate what you said about the power of these bear market rallies because we actually just wrote that up today in our daily. And in fact, Mark, if you put up that first chart, this is the one that we ran with some commentary about the tendency for these bear market rallies to be extremely powerful, but also very fleeting. And so what this is basically showing us is that short-term sentiment, I don't know whether this is measuring the hedge fund community or just, maybe the Reddit, Robinhood traders, whatever the cohort is, but you can see that it's been pretty accurate in terms of when it goes way down, it's a pretty good time to buy in the past, and when it goes way up, it's a good time to sell. So it plunged during the recent, kind of mini bear market, and then it's come rocketing back up as stocks have rallied. So I think this is a pretty good warning sign too. Same thing with the VIX. The VIX, I believe, briefly touched 60 intraday. Not it didn't close there during the worst of the sell-off, and it's now receded back down toward fairly normal levels, a little bit elevated. So that was the combination of this one being at a very low level and the VIX being very high was a great buy signal for just short-term trading, and it worked. But now we're kind of seeing the inverse of that. So I totally agree with what you just said, and I think people have a tendency to say, "Geez, look at the strength of that rally. This must be a new bull market." And yet, just time and time again, as you articulated, this is a classic signature of a bear market. All right, so we want to look at another one that also is a concerning one. I know you've talked about this and written about this, Jesse, just the concentration in the S&P 500. We kind of know that, but it's still to see it visually and to see it, basically at a 60-year high. This is, back in the early 60s, you had Xerox and IBM and a handful of others, Kodak, that were dominating the market, and there just weren't that many stocks that were publicly traded back then, at least of any consequence. So this is another, warning sign because you can see in the past these peak levels of concentration have consistently led to market declines. Okay, let's take him to his next, which is actually a Jesse Felder special with its usual visual appeal. And so why don't you comment on this one? This was from one of your recent newsletters.
Yeah, this is just, I've called this for the last couple of years. I've called this the most important chart in the world.
Well,
It's
that's
the
a good
chart
one to
of
talk about then.
the 10-year Treasury yield, because, obviously so many things are priced based on this interest rate. And we've seen kind of a succession of higher highs over the last few years, which is kind of the definition of an uptrend. We've had periods of consolidation and then we break out higher. And I think that's what we've seen since late 2022 until early this year is basically a pretty big consolidation range. And then it broke out, in late last year in the fall, uh, above kind of that, I would call it a bullish flag pattern for interest rates, which is typically from a technical perspective, a continuation pattern. So that breakout higher, back above the 420 level, and out of that bullish flag pattern suggests that we're headed potentially for another higher high before this longer term uptrend is over. And that would suggest at least a test of 5%, potentially as high as 5.5%. I think as long as we stay over this 420 level, 4.2% on the 10-year, that we have to, kind of pay attention to the possibility for a new high in this all-important interest rate.
Right, absolutely. And you've made the point in your recent writings that one thing to be really on alert for is a situation where you get, you know, turbulence in the financial markets, or you get recessionary types of indicators, and interest rates go up instead of down.
Yeah,
And that's what we've had recently. It's a very, very unusual. It hasn't been pronounced, but it has been, fairly fast. So we basically went from, I think the low was 380 on the 10-year, maybe 370 on the 10-year here recently. Then when the market really was selling off, it then went to 450. Lots of rumors of hedge funds under pressure, getting margin calls. It did feel to me a couple days there earlier in the month like it was a global margin call underway
mhm,
with the free fall even in conservative securities for a while. And of course, 10-year treasuries are supposed to be among the most conservative in the world, but are they really?
right.
And I think what we're seeing is that, and also credit spreads have also been jumping significantly too. So you get two warning signals out of the bond market. And then a third, which we'll look at here in a moment, is the dollar, because typically the dollar would rally during times of chaos or uncertainty or rising fear. And that didn't happen either. The dollar was going down. So I think there's some definite warning sirens going off right now in these. So Mark, why don't we look at the next one?
Yeah, this was a chart that I shared from Simon White, who writes for Bloomberg, who
Bloomberg.
is kind of done some great work on what's going on here, pointing out foreign ownership of equities and bonds is just grown to essentially the whole world is now overweight U.S. assets. Um, and what we've seen in with bond market selling off at the same time stock market and the dollar is some people are calling it signs of capital flight. But I think potentially what is going on in the treasury market is as Simon points out, is this are treasuries still risk free when the country issuing them is the source of that risk? And so, I think, when you think about how what does that mean? What does it mean that, treasuries are not necessarily risk free anymore? Well, it seems to me that the end game for a lot of the tariffs and whatnot things that are happening, and I think the administration's been pretty honest about this, is they believe the dollar's overvalued relative to major trading partners. They want, you could say either a lower dollar, or they want, euros and yuan and Japanese yen to be revalued higher. It's difficult to tell people to continue to buy your bonds when most of them are bought unhedged in a currency that you want to devalue. So, I think that is a risk that's potentially starting to manifest in the treasury market for foreigners, especially for all, assets, for equities, and bonds. That if you own these things as an overseas investor unhedged, you really do have some currency risk right now, because it looks like a lot of the intents of the administration is very similar. I don't know how much detail you want to go into this, but when Nixon closed the gold window, implemented 10% across the board tariffs, price controls to try and rein in inflation. And the intent of a lot of that was essentially to revalue the dollar lower. And so I think we kind of have an interesting analog there, where a lot of what's going on, could just relate back to the currency. And if you do want to devalue the dollar, it's going to be difficult to keep foreigners interested in continuing to own these assets.
And actually, that stratagem by Nixon in 1971 worked. I mean, the dollar did weaken. In fact, by the end of the decade, it was, really a sick currency. And of course, we had a lot of inflation as a result of that. And then maybe another analogy is what Reagan did in the mid 1980s with the so-called Plaza Accord. And now there's rumors of a Mar-a-Lago Accord, all to get the dollar down. It's one of the reasons why we've been, and I think you have been as well, big fans of the yen. We've told people we think that the yen is one of the few anti-fragile assets out there, and what that buzzword means is basically a portfolio protection security, and it's worked. I mean, it's up 10% or so this year when so many things are down, and that's it probably has a lot further to go. It's still deeply undervalued. So that's a good comment. Ironic, I was smiling when you brought up Simon White because I just listened to him last night on a podcast on Macro Voices. He's such an articulate guy. And then I also listened to a couple of days ago a podcast with James Aitken and Grant Williams and Bill Fleckenstein, and he was on talking about much the same thing that you are, and basically this kind of an impossible goal of trying to drive foreigners away from your financial markets without creating a lot of turmoil. And particularly for the Trump administration, I think the bond market right now is more important to them than the stock market, because they really want to help Main Street, and they want to help Main Street by getting interest rates down and helping housing affordability and that type of basically the people that are borrowers rather than lenders, and that's really what Main Street tends to be. So Aiken had a terrific quote I just read this morning, and it was, how do you soft land a hyper financialized economy when U.S. household net worth is approximately 8 times personal disposable income? And so I think this is another one of the big quandaries that the Trump administration forces, is if you're going to punish Wall Street or take away the puts that have been in place, there was downside protection, the plunge protection team that comes in whenever the financial markets are in a lot of stress. If that's not going to happen anymore, and you're really going to allow this thing to play out on the downside, what does it do to the economy? What does it do to U.S. tax revenues? So it just seems to me so many of the things that they're attempting have got countervailing forces at work. So any thoughts
Absolutely.
along those lines?
Yeah, no, I would just point out, that piece that Aiken put out was really interesting. A good quote from it is, he says, "I'm often asked, how is Europe going to fund the purchases of the ever increasing amount of boons and joint EU bonds they're going to issue? The answer is staring us in the face. They'll fund it out of the S&P 500." Right.
Yes,
So,
yes, he did make that point repeatedly in the podcast, and I thought that was very fascinating. And to me, it's we're really playing with fire, because I believe foreign investors own about 16 trillion of U.S. stocks,
mhm.
and if they feel like the dollar's headed down, the U.S. stock market's headed down, I mean, what are they going to do? They're going to press the sell button, and there's not a lot of love right now for America in a lot of these foreign, say central banks that tend to be big holders, or foreign institutional investors. So to me, that's really that's the worst case scenario. That doesn't mean it's going to play out, but it's a risk that doesn't seem to be appreciated right now. It's still a very, very expensive market, as you well know.
Yeah. Well, as Buffett has pointed out for years and years, the trade deficit is, a capital surplus to the rest of the world, right? We buy their goods and they end up with excess capital. That excess capital is recycled into our asset market. So you want to reduce the trade deficit, you want to reduce the amount of capital the world has to invest in your securities. So that's just kind of the math of, the economics of it. So, I think that's something to pay attention to.
That's a great point. And I just think expecting a pain-free resolution out of that situation you just described is kind of naive. And I just think people need to have some real serious hedges in place. That's why we've been pounding the table on the yen and gold for that matter. And let's talk about gold in a bit. But Mark, you have a chart here on the dollar that I think is a really interesting one because it relates. And if the Treasury market is the 10-year Treasury note is the most important chart, I think the dollar is maybe the second most important chart.
Yeah, you're probably right. Yeah. So
And
this is,
so you go ahead. This is your
yeah, this is
baby.
my chart of the dollar index. And, the last 15 years, we've had a pretty clear, bullish uptrend channel. A real clear line in the sand, however, has been this, 100 level. That's marked with the horizontal line on the chart, where it represented resistance, upside resistance from 2015 to, 2022 timeframe, and then broke out to the upside in 2022. Since then, over the last couple of years, it's been very clear support level for the dollar. So if we were to break down below this, I think it would be a really clear sign. And right now we're kind of flirting with it. I think we're around 99 or something. Very clear signal that this uptrend is potentially reversing to the downside. And that has just enormous implications for, what do you want to own? What do you want to focus on in your investment portfolio? During a dollar bull market, I think you want to be highly focused on financial assets, stocks and bonds do well. Dollar bear market, you really want to focus on real assets. And probably a good example of that would be from the last major dollar bear market was from 2001, 2-ish timeframe is when it topped out and bottomed around the 2009, 10, 11 timeframe. And what did well during that decade were commodities, oil, gold, these types of things. And so if we are seeing a major reversal in the dollar, it has just enormous implications for investment portfolios.
Couldn't agree more. And I think you can say the same thing about the 1970s and to a lesser extent the mid 80s after that Plaza Accord. So that's a great segue into the one hard asset, one natural resource that's really been a superstar lately, and that's gold. And we don't have a chart on it, but I think everybody knows it's gone up substantially over the last, well, particularly the last 15 months. In fact, we flagged it when it broke out, and I'm sure you did too, Jesse, when it had its big breakout over 2,000 back in early 2024. So it broke over 2,000 an ounce, and now it's what 3,300 an ounce.
Yeah.
And so I think a question, a reasonable question is gold a new bubble? And should people be scaling out of gold to the extent that they hold it? I mean, unfortunately, most U.S. investors are very light in gold, but not everybody. There are people that have been big gold, been derided as gold bugs, and they're finally having their moment in the sun. But it does look pretty expensive. And I know we're going to talk about oil here coming up, but what's also interesting are the gold miners, which, as gold was taking off last year, gold miners were going down. It was one of the craziest divergences I've ever seen. There was a lot of volatility, and we fortunately were able to kind of trade that volatility pretty well and really pounded the table on them late last year, early this year, that the miners were a great buy. And man, they have just come alive like crazy. And yet, what's interesting, if you look at, I just was checking a chart of flows into the GDXJ, which are not into, they're out of it, ferociously. You would think this thing is in a terrible downtrend. So at least with GDXJ, maybe that's, sure there's going to be pullbacks, but they could be pullbacks within a bull market. So that's kind of intriguing. But another one that I would bring up that's precious metals, but kind of a little bit less precious is silver. And it's a beautiful chart, great breakout at about 29, and it's I think 33 and change right now. So not up a lot from the breakout point. And I just saw a chart of short interest on the SLV, the silver ETF, and it's very high. I mean, it's like record-breaking high. So those two things, the GDXJ flows and the silver chart, that would indicate to me that those could go a lot further. So maybe for people that have missed the gold bandwagon, silver might be a possibility. Then there's also platinum you remember for years, in fact, I think you even you did a podcast once where you said, okay, well, there's the gold standard, then there's the platinum standard, the platinum standard. Well, really now it should be the gold standard up here and the platinum standard down below it. People, they're going to
Yeah,
have to reissue all those fancy credit cards now. But because what
that's
platinum
right.
is a third the value of gold. It's just not the way it's supposed to be. But of
Right.
course, central banks don't buy platinum, or at least not that I'm aware of, but they love gold. And I think what we're seeing is a replacement of, even if the dollar is still the world's reserve currency, which it is, it's really not the reserve asset of choice by central bankers. So well, you're talking about the trade surpluses that they accumulate. So they used to put those in treasuries, but now increasingly they're putting those into gold, and they're kind of a price insensitive buyer, as they often are. So that you've had that tremendous ballast for gold that you haven't had for the miners, you haven't had for silver, you haven't had for platinum. But those things could definitely play catch up to gold over the next 4 or 5 years. Do you have any
Yeah.
thoughts about some of those other commodities?
I think one of the most interesting ways for me to analyze the commodities markets is because they're kind of difficult to understand what is, fair value of any given commodity. I mean, you can compare gold to real interest rates and these kinds of things, which, sometimes works well, sometimes it doesn't. I like to compare them to each other. So, using something like the gold to oil ratio gave you a really good, sell signal in gold in early 2020 when, the oil price went negative and gold went through the roof. It was a great time to rebalance out of gold and into oil. Vice versa, in early, kind of mid in summer of 2022 was a great time, when oil had been doing pretty well and the gold price was really depressed. It was a terrific time to transition out of, the oil stocks and oil, investments and back into gold and the miners. And today we're at the point where, gold is extremely overvalued relative to the oil price once again, or you could just say the oil price is really cheap relative to gold. I think actually outside of the pandemic when oil price went negative, the oil price has never been as cheap relative to the gold price as it is today, at least over the last few decades. So to me, I think it's a really interesting opportunity to, rebalance a little bit out of gold, which, to be very clear, for the last number of years, I've written that I think we're still in a generational opportunity for commodities, broadly speaking. I think we're still in the early to maybe middle innings of a commodity super cycle. So I'm bullish on the group, but within that, I think it makes sense to kind of rebalance out of some precious metals right now and into the energy stocks and things which are supremely depressed and significantly undervalued, I believe.
Yes, you're right. I totally agree with what you just said, and it's fascinating if you because 22 was an interesting year for commodities. When the invasion of Ukraine happened, pretty much all commodities went ballistic, and gold was kind of left behind in that. And then since then, there's been a pretty wicked bear market in almost all commodities, even agricultural commodities, which who would have thought, given the invasion of a major grain producer. But I mean, silver is an exception because it's kind of ridden the coattails a little bit of gold, but nowhere near as much. But I mean, obviously, energy's been down. Uh, Uranium has been hit really hard lately. Lumber prices, of course, crushed. Most metals, industrial metals prices hammered. So it's an odd situation where you have such a divergence between gold and these other commodities. And I think you're right. I think for somebody that says, "Look, I've made a lot of money on gold. I don't want to get out," but I do worry that it could correct. There are ways to redeploy and still feel like you've got protection against a dollar bear market, a secular long-term dollar bear market, which I totally agree with you that we're in the midst of, or the early stages of, really.
Hmm.
So Mark, let's put up some of these energy charts. Jesse's got some great ones. Literally on the edge of my seat. Okay, so
Yeah, so this is the commitment of traders report in for crude oil. Um, the red line there is the managed money position, which is usually a pretty good contrarian indicator It kind of indicates where how asset managers are positioned. And there's only been, a couple times over the past decade when they've been as bearish as they are today, had essentially a lower net long position than they do. And that was in, late 23 and back to, early 2016. But every time, they've gotten really underweight. It's been a good short-term indicator that sentiment has gotten way too bearish and oil prices typically bottom and rally over the next few months when you get down around this low level. So, sentiment among asset managers is really very bearish, and this is what you would absolutely expect heading into recession. The way oil price works typically is it discounts recession before the fact. Is that, and right now that's what I think the oil price is doing is pricing in recession. Once recession begins and everybody realizes, oh no, the economy's, turn south, the oil price starts to focus on, okay, what's the next 18 months going to look like? And are we going to start to see some fiscal stimulus? Are we going to get lower interest rates that could potentially prop up demand in the months ahead? So, oil price is a pretty good leading indicator of recession. I think that's what it's pointing to, and it usually finds a bottom before recession officially begins.
Absolutely. And one of the points we made repeatedly, borrowing from our friends at Cornerstone Analytics, Mike Rothman's firm, is that the futures market for oil is at least 30 times the physical market. So when you get the investment community globally that wants to hedge against a recession, one of the easiest ways to do it is just short oil futures. And most commodities, it's like 3, 4, 5 times. And he said it's been running at 40 to 50 times the derivative market relative to physical. So you've got the tail wagging the dog big time here in the energy markets. And one of the points we made this week is that if you even look at the Great Recession racked year of 2009, oil demand fell a little less than a million barrels per day. And the point we've made is since the invasion of Ukraine, Russia's oil production is down a million barrels a day. So just Russia alone, which gets almost no attention, bizarrely. And we've also got a peaking of the U.S. shales, which I just don't think people are appreciating. I think there is such a glut of paper oil, shorted oil, which eventually will flip and become a very bullish factor when those shorts have to be covered. But for now, you've got this kind of false glut of oil that's overwhelming the fundamentals because supply. Well, in fact, we got another chart. Let's run the chart that shows supply versus is it prices or is it positioning? I forget. I have it here. I should
Yeah,
look at.
it's just the oil price and that versus inventories, I believe.
There you go.
Yeah, I've kind of inverted oil price or inventories on the chart, so you can see that oil prices continuing lower, but inventories, like I said, are inverted on the chart, have not been making new highs. Inventories have generally been trending the other way, which should be typically these things run pretty closely together. And the fact that your oil price is making new lows and inventories is not making new highs is, I think, pretty bullish, generally speaking. So, it's a good point that you make that a lot of the oil price weakness is not necessarily due to fundamentals. It's due to, speculators, in futures, getting extremely bearish.
Yes, and I believe that inventory chart that you have there is adjusted for the SPR releases, or it includes the SPR releases. In other words, if you back those out, inventories would be a lot lower because that was
Yeah,
about 300
absolutely.
million barrels that the Biden administration released
Yeah.
for non-political reasons. I just want to make that very clear. Okay. All right. I think we have another one that looks at flows for XLE
Yeah.
energy ETF. Yeah, there we go. So
Yeah. So you
saying the
have
same story.
Right. Yeah. So the money that's come out of the XLE ETF in the last 12 months, $8 billion of outflows. It's bigger than anything we've seen in the last 10 years. I've run another version of this chart where you look at 3-year outflows and it's even more dramatic. And so, to me, it's pretty astounding that we've seen such a massive shift in flows. Investors just, have zero interest in owning these things. They've cut positioning down to nothing. And we've remained above technical support level, around $80 on XLE. It's almost astounding that the price has been able to hold up so well, even in the midst of this much selling. But it also points out to you that if sentiment were to turn around for any reason and outflows just shift, just stop, and you don't even need really inflows, that you potentially be very bullish, for energy ETFs. Obviously, if you get a turnaround and people start buying these things again, you can see what happened in that 2021, 22 timeframe when outflows turned to inflows and drove, a tripling in the value of the ETF in just a year or two, time frame.
Well said. And to put a fine point on that, one of the reasons I think you've had this relatively resilient performance by XLE is, of course, it's cap weighted. And the Exxons and Chevrons have held up reasonably well. You get down below that, start getting to the smaller cap energy names, and they have been absolutely destroyed. Looking at APA, for example, which is down from 50 to 15-ish, something like that, the old Apache. And then you
Yeah,
got the oil service companies, particularly the offshore, Belarus, Noble, and it's just been an absolute, just they've been like internet stocks back in 1999, well, sorry, 2000, 2002. So it's really been terrible damage done, but enormous
I'm
rebound
glad you brought
potential.
those up because APA is one of the only stocks I've seen with some interesting insider buying
It
in the
has
last
had, yes.
month or two. And then, those offshore equipment companies, Noble and Tidewater have had,
Valeris,
interesting insider buying over the last couple of months too. Very compelling insider buying. And you don't get buying in those companies unless they believe the oil price is going to be much higher in a year or two from now because, right? I mean, the break even on production and offshore stuff is not terrific, and they need to anticipate that we're going to have much higher oil prices going to drive drilling demand in those offshore wells over the next couple of years. So I think that's another very bullish indication that we have some compelling insider buying. Not to mention the fact that over the last year, I've highlighted the number of celebrity billionaire investors who have been buying heavily into the energy sector. Warren Buffett is one who's been buying. The only thing he's been buying in the past year is Occidental Petroleum. But you have Jerry Jones, owner of the Dallas Cowboys, who was buying heavily in Comstock Resources when that stock was down. Um, New Fortress Energy is another one. And then obviously Carlos Slim has been one of the only things that he's been buying is PBF Energy, and just buying
the
it.
refiner. Isn't that a big refiner? PBF?
Refiner, exactly.
Uh-huh.
And he's been buying a ton of stock over the past year. So that's really some of the only interesting insider buying activity I've seen is in the energy space. And it's among, not just the managers, CEOs and CFOs of these companies. It's these, like I said, a number of these big billionaire investors who have been clearly wanting to add an energy component to their portfolio. And I think that's another kind of a macro signal of what to expect over the next few years.
And just to give your newsletter a little tout, you did a nice write-up on Oxy. You pointed out here recently that you can buy it at a cheaper price than Warren Buffett's average, and he's been buying it for years. So it's been a dog for him at this point. For a while, it looked really good. So I just want to endorse your newsletter. I think it's a great value. Anybody that's listening and watching that isn't taking your newsletter, I'd encourage you to sign up. It's pretty easy to find you, right? Don't you? Can they just go to Google and
Well,
put in Jesse Felder?
yeah, it'll come up, I'm sure. I appreciate the
Yeah,
plug.
anything close to it. Jesse James Felder, it'll probably come
That's
up.
right. Yeah.
All right, so let's see. I think we have one more visual and then we're done on visuals. But we got a few more things to talk about. We'll try to get to the Q&A soon. Is it the equity valuations versus interest rates?
Mm,
We might have skipped over that one earlier.
yeah,
There
that's
you go. There you go.
I think, this is a fascinating chart to me because you could see basically this compares the equity earnings yield, which is basically just, the inversion of a PE ratio compared to the 30-year TIPS yield. And, finance theory would suggest that, there should be a very close relationship with these, that, like when real yields are higher, you should invest in those. And when earnings yields are more attractive, you should invest in those. And that was the case, for most of the last decade until the last couple of years, when real interest rates have continued to make new highs. And last week we saw a new, multi-year high. And equity earnings yields have gone the other direction. So you could say either stocks are discounting a return to very close to negative real interest rates, or they need to reprice significantly higher. You could see even over the last 10 years or something, the high end of this range has been close to, 6%, 6.5% earnings yield. That would put the S&P 500 at about 4,000, if it were to be priced along the lows, the other lows we've seen over the past decade. But real interest rates would say you could even go lower than that. So to me, this is the real risk with interest rates right now, is they pose a very compelling alternative. Real interest rates do, tips, and I think this is also why, gold is so popular right now too, is because gold and tips kind of trade similarly. So you could say that if tips are this attractive right now, gold is roughly just as attractive as tips are, because they're priced similarly. But yeah,
Jesse, sorry, just so people know that what tips are, so most people do, but not everybody, that it's a treasury inflation protected security. So
yeah.
when he says real return, he's talking about the interest rate minus inflation, and it's very unusual to see it trading at this high level relative to stock prices.
It's unusual for the last decade. I mean, it was actually very typical for, pre the great financial crisis,
Good point.
very typical for tips to yield 2.5% or something. So we're kind of back to normal in terms of what we should expect from the bond market, but we're not back to normal equity valuations. So I think in terms of this real interest rate here, I mean, you can go buy a 30-year tips and it will pay you, more than 2.5% above inflation, guaranteed for 30 years. That's a pretty attractive return, compared to stock prices today, which are valued as if real interest rates were closer to zero. So this gap, I think, is probably going to be filled one way or the other. Now, I don't know which way it's going to be filled. Either, stock prices need to come down a fair amount and become, closer line to real interest rates, or, there's obviously the potential for some type of yield curve control in the future that would potentially depress nominal yields and bring them down closer to stock prices. So there's a possibility we meet somewhere in the middle. But still, as I said, for stock prices to get to, valuations that would be in line with their low end of the range of the past decade, that's about 4,000 on SPX, which I don't think a lot of people are looking at as a potential outcome.
But given all the macro threats out there, that's actually not a very alarmingly low target, considering that twice in the last 25 years, we've had basically the market cut in half, 2000, 2002, and then again from 2007 to early 2009. So it seems impossible based on what's happened over the last 15 years, but not the last 25 years.
Well,
So
and
this,
that real interest rate, that's what that's pointing to. If that those alligator jaws collapse with stock prices meeting real yields, you're probably talking closer to 3,000 on SPX, which would be, that 50%, drawdown that you're talking about.
and just so people don't feel like we're apocalyptic or they, have to keep all sharp objects out of their reach, but it doesn't have to be a bad thing because if you were properly positioned in the 1970s, if you recognized the major forces that were at work back then, you would have done very, very well, for the, say from 1972 to 1979, and then been in a position where you could have cashed in some of your hard assets and bought incredibly depressed financial assets. And I think that's what we're going to be seeing again. So this is a good lead into what I think is kind of the ultimate macro question, which is, in your opinion, are we in the famous fourth turning?
Wow. Um, I think we
I
just,
didn't say this would be easy, Jesse.
I mean, it is a great question. I believe the answer is yes. I also believe, that I don't have a great deal of confidence at all in trying to, try and game plan what that looks like. I think it's a lot easier to kind of um, look at these types of indicators like the dollar equity valuations and things and understand just from the data. I want to make sure that I'm well diversified and especially probably overweight real assets in an environment in which the dollar is likely to head lower. Um, and, if we are in the midst of a fourth turning, then that probably works in that type of an environment anyways. I think, what is a fourth turning? I think, probably what we're talking about here is for so long, I just, the chart that pops into my head is corporate profit margins going to record highs and labor share going to record lows. And Warren Buffett wrote about this 25 years ago and said, this cannot last for very long without running into political problems, right? Those are the political problems we're running into now. And it's a product of globalization and a lot of things, shipping jobs overseas, hollowing out the middle class, our manufacturing here in the United States has allowed, labor share to corporates to profit at the expense of labor share. So I think one of the things that we're talking about with deglobalization and stuff is trying to reverse that. And so that means if you want to bring labor share up and kind of see a more equitable sharing of that pie, as Warren Buffett would call it, you're going to see corporate profit margins go into a secular decline, labor share into a secular rise. That's probably also inflationary too. And so that goes along with what we're talking about in terms of the trade deficit and whatnot is I think that's very closely related. The blowout in the trade deficit is the one of the symptoms of the globalization and the offshoring of production and all these things that we've seen. If we want to reverse that into deglobalization, you're going to see a narrowing trade deficit, but a rising labor share, falling corporate profit share, and probably a secular rise in inflation. So to me, I think that's an easier way to think about it than what is, the actual, political, geopolitical environment look like.
Well, you touched on something that's a hot button issue for me, and that is corporate profits. And what is one of my pet peeves is that Wall Street maybe intentionally ignores this century-old equation, Kalecki-Levy or Levy-Kalecki, which is that there is a very tight correlation between high levels of deficit spending and corporate profits. And obviously, we've set records in terms of non-depression, non-wartime deficits. And so it's been a huge tailwind to corporate profits, along with these globalization trends, the China price, which was, basically in helping companies with, low input costs and suppressing labor costs. And so many of these things are reversing. And I, just got to believe, obviously, Doge is attempting to get the fiscal, what I'd call the federal fiscal financing fiasco under control. Whether they'll be successful, of course, is a very open question. But something's got to be done. We cannot continue to do this, and maybe it'll be that we lose these international investors who've been willingly funding us either through the Treasury market, not so much lately there, but also through the S&P 500. So yeah, I think big changes are coming, and I think just whether it's domestic or international, the reality is people are very, very overweight the dollar, and they're very, very overweight dollar assets. As you know, the U.S. got up to 75% of the MSCI market cap here recently, and that's just astounding. So there's a long way to retrace back to more of a normal type of a level. All right, maybe we should open up to questions now. It looks like we've got some that have come in.
Yeah, whoever has any questions, just feel free to unmute and ask away, or you're welcome to add something to the chat and I can relay it, of course.
Okay, if we have a little bit of a lag, one thing I forgot to bring up, and this is something I haven't heard from anywhere else, Jesse, but I did just see a little squib on it in Luke Groman's latest, which is another R word, not recession, but reparations. So this is something that I've been kicking around and talking about a little bit, writing about a little bit, which is it seems to me at some point Donald Trump's going to kind of connect the dots and go, hey, wait a second, why aren't we hammering the Chinese for COVID and the trillions and trillions of dollars that cost the world? And it, for a while, it was just kind of a crazy Dave theory, which I'm very good at those, off the wall things. But if you didn't see this, Missouri just got a judgment against China in for $24 billion on a COVID lawsuit, and they're looking to seize Chinese-owned farmland in Missouri. And to me, that's the tip of the iceberg. I've just been amazed that, especially as all this evidence has come out, that it was indeed the Wuhan lab that was the source of the COVID, global pandemic. That China's really gotten a free pass on this. And have you ever heard the interview between Grant Williams and David Murin?
I have not, no.
It's quite fascinating. Apparently he wrote a very famous book on this topic, back in like 2009, where he predicted it. His view is that China intentionally released it. It's kind of an act of war.
Mm-hmm.
I doubt that personally, because obviously China suffered mightily from it. But the idea that I think it was just sloppiness. For a BSL-4 lab is supposed to have the highest safety measures, and it clearly wasn't even close. So I think you're going to see a lot more of that, which is just going to be another kind of destabilizing force, even though I kind of see the equity of it. All right, enough on that topic. But unless you have anything you want to add to that.
Yeah, no, I think the thing that we can glean from that and that those sentiments and my friend Peter Atwater does some terrific work on kind of tracking these narratives and sentiment. Is it very clear that there's now bipartisan sentiment to disconnect from China on a multiple number of levels. So whether it's economic and supply chains and these types of things. So deglobalization, I don't think is a theory anymore. I think it's happening. And if you believe that globalization was the source of disinflation and growing profits and lower labor share and all these things that have kind of been a boon to the markets over the last at least 10, 15 years, if not 30 years, if those are, globalization is potentially going in reverse, a lot of those tailwinds to asset prices and profits and things are potentially turning into headwinds. And that's a problem for it. Basically, to me, it just suggests, as a number of other commentators have pointed out, we're in the midst of a sea change, right? What the world has looked like for the last 25 years, it's not going to look like in the next 25. And so adapting your portfolio and your macro views to the new reality, I think, is one of the most important things people can do generally.
I agree totally, wholeheartedly. Do we have any questions, Mark? Besides, what's Jesse's handicap?
We do. We do have one from Nathan. To what extent are you concerned about a ceasefire in Ukraine raising supply of oil by allowing more Russian refineries to come back online?
I can take that one, Jesse, if you'd rather.
Sure, go for it.
I think very little. And I think the problem that I don't know so much the Russian refineries issue as much as Russian production. I think those refineries I don't know that they export any refined products. I could be wrong about that. They certainly export a lot of crude, and that crude production is coming down as we saw. And I think they have a real problem structurally because of the lack of Western technology and the fact that those are pretty old oil fields that need a lot of stimulation. So I think it's in the midst of a long-term decline, Russian oil production. And I think it's going to be hard to reverse. I mean, they can do it, but it's going to take a lot of money and a lot of time. Be kind of like Venezuela. I mean, if you wanted to talk about what could really be a wild card to create a tremendous amount of supply, Venezuela has oil reserves greater than Saudi Arabia, and yet they produce barely enough to supply their own domestic markets at this point. So I don't worry about that. I guess kind of the proof in the pudding is how has oil done since Ukraine was invaded? I mean, it's lower. So the invasion of Ukraine has not been a boon. It was initially. Oil went through the roof. I think it hit 120 or 125 as a high, but obviously we're about half of that now. Could be wrong, but I don't see that. I mean, I think you could see temporarily kind of a knee-jerk reaction if there is hopefully true truce over there, that you would have a temporary drop in oil prices. But right now the bearishness is so intense, I kind of doubt it would be much of a reaction. But Jesse, do you disagree?
I think we have to remember that markets are trying to discount all of these types of things at all times. So if it looks like there's potential for peace, that's going to be in the price almost immediately. Markets are now run by algorithms and things that are scanning and doing much faster work than any of us can absolutely possibly try and hope to keep up with and read. So I think the question is not necessarily would that be bearish for the oil price, but what's priced in? What is actually discounted by today's oil price? And I would say at $60 a barrel, you might have already discounted Russian energy coming back into the market. You might have already discounted some suppressed demand as part of a recession. Obviously that's open for debate, but yeah, to me, the oil price at $60 a barrel has already discounted recession and a pretty bearish supply-demand dynamic. So any news to the contrary would be bullish for prices and have to change that discounting mechanism. So you get demand surprising to the upside. As you talked about, I think the shale side of it is another very bullish dynamic. If production from shale, and we're seeing the number of rigs continue to fall significantly, operating in the shale space. So you might see U.S. production, lower than expected, in the months ahead. So, yeah, I think that a lot of bearishness is already discounted in the current oil price.
Yeah,
We
another
have
comment about Russian oil, just real quickly, Mark, is that there hasn't been a drop off on oil exports by Russia. They've gotten their oil to market. Where they've not gotten their energy to market is with natural gas because of the lack of pipeline access and the Nord Stream sabotage. So I would think gas might be a bit more of a different, where you could see a surge of supply into Europe of Russian natural gas, which could bring down European natural gas prices, which are way, way above the U.S. Last I saw, they were mid-teens versus sub 4 in the U.S. And then Canada, I think they're in the twos still. So that natural gas is an odd one in terms of tremendous divergence in global pricing. Sorry, Mark, you had another one?
Yeah, we have a couple of detailed questions on oil I want to get to, but I don't want this really brief one on the yen to get overlooked. So just really quickly, Jay Tilley is asking, what level and over what time frame are you targeting on the yen? I guess that's either
Wow,
one of
that's
you.
a tough one. You're never supposed to say time frame and level together, right, Jesse? But I would say, you from a price target standpoint, 120 would be pretty conservative. I think it could get below that. So realize that when the yen goes down in number, so it's like 142 or 3 right now, sounds like it's going down. It's actually going up because it's taking fewer yen to buy US dollars. And one of the reasons I believe that, actually, Jesse can comment more on this more intelligently because he was recently in Japan, well, I guess last year, and saw for himself how unbelievably cheap it is to be in that great country.
Yeah, when you just look at a weekly chart of the dollar yen, we've formed it, and I'm surprised. I like these chart patterns when you don't hear anybody talking about them. When everyone's looking at a chart pattern, they don't typically tend to work, but we have a pretty clear head and shoulders top pattern working in the dollar yen. That's about, been forming about 2 years with a neckline right around, 140. So you just take the top of that head, it's like 162.50, something like that. So you'd think a break under 140 would take it down to, under 120. And so I think that is an interesting that you bring up that target, because that was technically where you'd probably likely see it trade just from a pure technical standpoint. But yeah, I was in Japan, and I took my son out. We were in Osaka for a couple of days, and we went out for an amazing steak dinner, Matsuzaka beef. If you haven't tried it, it's like Kobe and Wagyu, and Matsuzaka was just unbelievable. We stuffed ourselves with the most amazing food, and I think it was still under like $200. And I told him, if we went to a Morton's or a Ruth's Chris or something like that, it would be at least triple the price. So yeah, it's a great time to visit Japan right now with the yen so undervalued.
And well, it's rallied. I mean, I think at the low point when the yen was pushing 160 to the dollar, it was something like 45% undervalued, on a like the Big Mac index type of thing. They're similar, real exchange rate basis, but it's still got a lot further to go just to get to fair value to the dollar. And what's to say it can't overshoot and
Yeah.
actually trade expensive relative to the dollar? And that's when you could be talking, say, 80.
Yeah.
But it's not going to be a straight line. There's going to be a lot of back and forth, and I do think this 140 is kind of a critical level. That's about where we hit last summer when it triggered the big sell-off around the world. It's interesting. This time it's almost back there, and there isn't much focus on it. It's kind of been a stealthy move by the yen, which I think is kind of encouraging as well. All
Yeah.
right, we got somebody else with a question about refineries, I think.
Yeah, well, we've got a hefty one on oil, but we've got another one on the yen.
Okay, go ahead. We'll stay on the yen.
It's in the yen, okay.
I got a yen for the yen, as everybody knows.
This is from Pete, related to the yen question, and another really important chart is that of rising JGB yields. They've almost tripled in the last 3 years. Doesn't this inexorably lead to higher for longer U.S. rates, weaker dollar, and maybe higher inflation? Regardless, how do you factor JGBs into your overall macro picture?
Well, I think it's huge. I'll go first just because that's been a big topic. I mean, actually, the guy that really got me thinking about that was our aforementioned James Aitken at a podcast he did with Grant Williams back in, I think it was the late 2023, fall of 2023. But because he'd met with Kuroda, the former finance minister, like the head of their head of their Fed, and he was saying that he thought the rates were going to go much higher. In fact, I think he even used 2% as his target for the short-term rate, which at the time was basically zero. And at first, it didn't look like it was working. But now, as time has gone by, certainly the bond market's been moving that direction very aggressively. And it's, the 10-year is one thing, but I think if you look at 30-year Japanese bonds, they're more like around 3%. I could be wrong about that. Do you remember, Jesse?
No, not off the top of my head.
But they're way, way up from where they were and much higher than the 10-year and, of course, way higher than short-term rates. So they have a very steep yield curve. But it's important because the higher those rates go, the more that it makes Japanese institutions want to repatriate capital back to Japan. And Japan has been a massive exporter of capital to the US and other markets. So that's a big deal. That's one of the reasons why when JGB started to scream last summer, the yen did the same thing, and markets around the world buckled because it was basically spelling the demise of the yen carry trade, where you borrow in yen and you invest at higher rates overseas. And when the yen's going down and you're getting the higher rates overseas, higher yields, it's like a double whammy, double win. And even Buffett played that game. But it's running in reverse now. And again, I don't think most people are appreciating the magnitude of this change. All right,
Yeah.
Jesse, anything you would add to that?
Yeah, I would just add that, the Bank of Japan has been very clear about, for years that they need to bring inflation back, essentially, do the opposite of what Paul Volcker did and break the back of deflation. They've clearly accomplished that, and they've said now they want to normalize interest rates. And so they're on a path to take the short-term rate to a normal level. And I can't remember who it was, but somebody pointed out recently that the Magnificent Seven price to sales ratio, the valuation of the Mag 7 stocks, has actually tracked Japanese real yields closer than our own real yields. And so that kind of, backs your point that as Japanese real yields are turning positive, I think they're right now the 10-year Japanese real yield is essentially right about zero. Um, you know, then as that rises, it makes it starts to suck, as you say, suck capital out of U.S. markets and back into Japanese markets because the financial assets there are starting to offer attractive returns. And so, so the fact that Bank of Japan is on this path that they've made very clear to normalize interest rates has very clear implications for U.S. assets and the Mag 7 included.
Okay, we've had a couple on energy in the comment section here for about 10 minutes, so I'm going to paraphrase them. Jay Tilley is asking about the best way to make your play on the oil price. Is it MLPs, upstream companies, a combination? And then Ben is asking, what will it take basically for the market to figure out oil, is how he puts it. And his question kind of ends with, is the Permian growth cooked at $60? So
I'd say
best
yes
way,
on that one. Just to
yeah.
cut to
So
the chase on that question, I mean, that's below the Dallas Fed says that the break-even production cost is 65. Now, there's obviously some super efficient producers like Diamondback Fang that maybe can produce at 55, just pulling that out of the air, but not many. And who wants to be in business just to break even? And so I think that's why you're seeing the rig count continue to fall. And it's the sentiment is very poor. So these guys are not at all incentivized to go out and spend money to find new oil and gas, and it's getting harder to do anyway. The choicest areas of the Permian and the Delaware, which is in New Mexico, have been largely drilled out. I mean, not totally, but largely. And it's happening. Really, all the major shale basins in the U.S. are seeing declining oil production. The Permian has continued to grow, but even its growth is slowed way down. And I do believe soon it's going to actually roll over and go slightly negative. It's just going to take more and more money, more and more sand. We're big fans of Atlas Sand. What's actually the formal name is AESI. I'm so happy I can mention these things now without having to worry about the compliance Gestapo coming down on me. But it's been a dog from when I wrote it up earlier this month. So it's really depressed lots of insider buying that Jesse would point out. In fact, they paid a much higher price than where it is currently. And I think when you see the next numbers, there'll be even more insider buying. Just a guess. I don't know that. So it's kind of to the other question is that I don't think the best way to play an oil recovery is with midstream, even though I like midstream in an income portfolio. But I think you could get 10, 15% price moves on, say an enterprise products, but you could get a double on Valeris and easily a double on APA, Apache, the old Apache. So I think you're going to make a lot more money with some of these ones that have really been bombed out.
Yeah, I mean, I was a big buyer of the midstream companies, over the past number of years. I've recently eliminated my position in the infrastructure companies. One of the best indicators that I saw was, Kelsey Warren at Energy Transfer was literally buying, $13 million of stock at a time, $38 million here, $47 million here, all the way up from single digits on ET up to, $15 a share. And it was just, I mean, the thing had a 10% dividend yield. I've seen literally zero insider buying in the infrastructure space in the past 12 months. And so I think insiders there believe that sector is probably fully valued. I haven't seen much selling to speak of either, so that's not necessarily bearish for them. I would just point out, I think what's going to take Wall Street to get bullish energy, as my friend Jim Paulson has pointed out, that the real driver of energy relative performance is a combination of the trend in the dollar and capacity utilization within the economy. So when you have a rising dollar and falling capacity utilization, less manufacturing and these types of things, it's generally bearish for the oil price relative to the S&P 500. So we get those things to reverse, where you get a bearish dollar and rising capacity utilization, and that creates a bullish relative trend for energy stocks relative to the S&P 500. So what does that come from? Well, we talked about the dollar. If we get this dollar, bear market that we're talking about, which I think is already begun, that's half the equation. The other half is that rising capacity utilization, more manufacturing, these types of things. That's the reshoring of production that we're talking about. That is literally now a bipartisan initiative to try and bring semiconductor production to the United States, reshoring a lot of manufacturing. So the way I look at it as the longer term macro bull case for energy has maybe never been stronger than it is today, because what are we trying to do? We're trying to lower the value of the dollar and raise capacity utilization. And virtually everything the administration is trying to do right now is to those two ends. To the extent they're successful, you're going to want to own energy as an overweight relative to the S&P 500.
And I guess I'd throw in another kicker that I don't think is really appreciated very much, and this actually benefits palladium too, is the EV versus hybrid scenario. And there was a real belief not that many years ago that EVs were going to basically take over the world, the auto world. And now it's very clear if you look at where the rapid growth of so-called EVs is, it's not pure EVs, it's the plug-in hybrid, basically they're gas and electricity driven. What's interesting I just read the very fascinating article saying that most people tend to use the gas part of it the most. I would have thought it would have been kind of the opposite, but part of it is in a lot of the emerging world where quite a few hybrids are sold, and that's where, frankly, the demand for energy has been strongest by far. There's really been no demand growth in oil in the developed world over the last 20 years or so, 25 years, but lots of demand growth in the emerging market. But the ability to charge an EV, in Jakarta or Mumbai is very poor. So they do tend to like the hybrids, and they do tend to run them on their gasoline. And the reason it helps palladium, as some of you know, is that the catalytic converters use palladium, and actually it uses more palladium in a hybrid than it does in an internal combustion engine car. And that's been one of the reasons why palladium has been sold down so hard, is this view that EVs were going to dominate everything. So I think there's some inefficiencies in there that an investor with a long-term time frame can take advantage of.
Quick note of clarification as well. Ben wanted to make it known that he was not questioning whether or not the Permian is cooked at 60, but rather stating that it's cooked at 60.
Okay.
So apologies on that, Ben,
Yeah.
and thank you very kindly for that clarification.
No, I think that's right. And I think I may have misspoke. Speaking of clarifications of Kuroda, I think he might have been the head of the Bank of Japan, not their finance minister. I'm not positive on that. But anyway, he was the guy. He was basically the Jay Powell of Japan back a few years ago before he retired.
We have one from Jim Edsel asking,
Hey, Jim. Now there's a man that can comment on the Permian.
Any thoughts on investing in Argentina, given Malay end of capital controls of Vaca Muerta?
Should have done it a year ago. It's been a huge winter.
Well,
but at this point, I don't know.
Brazil, then.
Yeah, Brazil to me is the one that's more interesting. I mean, the market is just phenomenally cheap. I think the CAPE on Brazil, so the cyclically adjusted PE is 6. Normally, that's not even the right way to say it. Very unusually, if you get down to 10, that's like a generational buying opportunity. That's like where the S&P was in 1974, 1982. It's what China hit here before its rally. So 6 is just stunningly cheap. But part of the problem, but also the opportunity, is that Brazilian 10-year government bonds yield 15%, and their inflation rate's about 5. So talk about a real yield. And I haven't looked at the numbers real lately, so it could be a little bit different, but I think still very close to a 10% real yield. And it's clobbering their budget deficit. So their primary deficit is, I think, in surplus, but because of all the interest that they have to pay out, they've got this big deficit. So that's been weighing on the market. They've got a left-leaning president, but he's up there in years. And I think they got to be looking at what's happening in Argentina and saying, look, if we kind of move toward what they're doing, even a Argentina light type of policy mix, we could have a great rally in our financial markets, which then, of course, spills over into the economy. So I'm very bullish on Brazil, but I have been, and it hasn't been doing very much, but it's been kind of hanging in there here during all the turbulence. But yeah, Argentina, I guess with Argentina, Jim, I'd say that when there are these shakeouts, Milei got in trouble with his, like his version of the Trump coin, and there were rumors of trying to impeach him, and that caused some weakness. So I think that you could buy into that market on weakness, but I wouldn't chase it into rallies for whatever that's
Jim,
worth, which is much.
You've got one on gold as well. If you're not shy about it, you want to unmute and ask directly?
Yeah, sure. Dave, you and I've talked about this, but when you think about if you think gold is getting toppy now or in the future or whenever, and you think about rebalancing and selling some of your gold, would that apply to physical? I mean, if all you own is physical versus ETFs or equities, would you still sell that as well?
Probably not, unless that's all you had. I mean, I think in the pecking order, you would probably sell the maybe the most fully valued, like an Agnico Eagle, at least trim it, take profits on it. Some of the gold miners that have really had monster moves. Some of them still look kind of undervalued, actually. So I wouldn't say that in a blanket way, but probably the physical gold that you keep in the safe deposit box. I mean, I have a feeling that's held for a different reason. It's maybe just in case there is, really bad stuff that happens where you really want to have gold coins to be able to make sure that you can pay your bills or get what you need to live on. And but I also think that gold does have this potential for a very, very big move. And what's been impressive to me, normally when you have the kind of move that it's had, you get this back and forth type of thing. you don't get that straight line up. It's been pretty much a straight line up. There was a dip of about 7%, I think, at the end of last year, and then just boom, right back. There's obviously an enormous bid for it. So it's almost like there is a pricing going on right now, or a discounting going on, that we are going to have a new monetary standard in the world of some kind, and that gold is going to go a lot higher in the process. And so that's why I would keep kind of a core position in gold, but be trimming a bit and redeploying into some of these things that I think will get pulled up by that. And I really haven't talked about uranium today, but uranium continues to be just phenomenally undervalued in my view, and has, I think, the best supply demand setup of any of the commodities. So I think just kind of gradually reallocating with staying within hard assets is the advisable course of action right now.
I apologize. Can I ask one more question?
Of course.
I don't think I've asked you this since the election, but and same thing for Jesse. Thoughts on Bitcoin?
Jesse, you want that one?
Had to go there.
I think, I mentioned it's difficult to understand fair value, and I really appreciate your points on Dave on the gold price. Like when I talk about rebalancing out of gold and back into energy, it's not because I think we're anywhere near a secular top in gold. I think gold, they're all going to be much higher, a few years from now, than they are today. I just think there's relative value spreads to be kind of taken advantage of within the commodity space. Now Bitcoin to me, it's very clear that it's a high beta asset that trades very like a leveraged NASDAQ type of security. So, that's to me, it's very difficult to understand if there is any intrinsic value there at all. I don't see it if there is. But what the history of it has showed me is essentially you might as well own a leveraged QQQ ETF. It's very similar to the trading in Bitcoin. So yeah, I view it as a risk asset for traders, and if that's what you're using it for, then more power to you.
And to chime in, I mean, I think it's very enigmatic. I believe if you're going to play crypto, that's the way to play it, because there is an inherent scarcity aspect to it, unlike so many of the others. And most of those other things, I think, are just going to be wiped out over time, and maybe that will funnel more money to Bitcoin. So maybe that's the bullish story. But I think Jesse's right that where Bitcoin has undeniably repeatedly failed is as an anti-fragile asset, like I mentioned with the yen and certainly with gold. Yeah, I keep waiting for the time where the Nasdaq gets hit hard and it goes up instead of down. And so far, that hasn't happened. When it does, ring me up and I'll maybe be more interested. I think the way to play Bitcoin is when it gets clobbered, and it does, dip your toe in and buy some, and then when it runs up, take some off the table. Play the swings, play the volatility, but to buy and put it away forever. I mean, you can do that with a core position. That's what I like to do with something that I really believe in long term. Is if I'm right and it goes up a lot, like uranium did for a while, then take profits, wait, see if it pulls back, and sometimes they pull back way more than you think they will. So, I mean, just look at Atlas, Jim, right? Who would have thought that we'd be seeing it down in, sub 14? But
Right.
I really do believe that one's coming back in a big way here over the next 6 to 12 months. I think you would agree with me on that one.
Definitely.
This is not a question, just comes from Brian. Valero announced today is closing another refinery in California. You mentioned Carlos Slim is buying PBF, which is interesting. The West Coast has to get refined oil from somewhere. All those energy names you mentioned, PBF, APA, NE, Val, TDW, OXY, have just been obliterated. Thank you. Yeah, no question, but if you want to comment.
Well, I have a couple of buddies that are part of my unofficial research network who love the refiners. They've been saying the same thing, and this is a trend that's been going on for years of closing refineries. And at some point, you would think this would be a great business to be in for the survivors. So I would agree with it conceptually. And I know there's some interesting one. I mean, the go-tos are Valero and Marathon, but there's this Par Pacific that's on the West Coast, and I think they dominate the Hawaii market, and it's been absolutely annihilated. So yeah, I would, and PBF, based on Carlos Slim's activity, I think Icon's buying a lot of one of his. I forget what the name of it is, but I think it's an area to check out. I don't own any personally right now, but it's definitely something I have on my thought list, to check out list.
Let's see. We did have one, just quickly, we had one asking whether or not these charts would be shared out. I think what I'm going to do is just put these in a standard Substack post. Two of them actually went out in today's daily. So to avoid redundancy, I think I'll just exclude those, and then the rest, which are all from Jesse, with your blessing, of course, Jesse.
Sure. Yeah, go for it.
Yeah, we'll just send these out as just for anyone who'd like them for reference.
And we've got a recording of this, so anybody that hasn't been able to, I know we had some people that said, I'd like to listen, but I can't, but they want to hear the recording. So we'll have that recording available for anybody that wants it, right?
Here's one. Yes, we will. Here's one from a bit earlier. Jesse, you wrote about the fiscal tailwind shifting to outside the U.S., and David has highlighted Brazil. Given the change in world dynamics, are there markets or regions you see as best positioned to benefit?
Well, I think generally, yeah, with the fiscal shift and the change, in the currency, I think the best way I think to kind of view that is to just understand that most investors are, suffer from home country bias, and usually to a very large degree in our people. It's not just foreign investors, it's US investors are typically overweight US equities within the portfolio. I think, these trends of a potential reversal to dollar bear market, to, fiscal, potentially I don't want to call it fiscal austerity, but relatively speaking to what we've become used to in the last few years, we're trending towards, more austerity here and a little bit more, fiscal stimulus around the world. Those trends argue, that it could be costly to be underweight the rest of the world relative to the US. And so I think at the very least, it argues that you should be well diversified, around the world. And you should at least avoid the sort of home country bias that would result in an overweight in overvalued U.S. assets when these kinds of trends are taking place.
And as a coda to that, I would point out that you do hear quite frequently, oh, well, you don't need to invest overseas if you buy a very diversified U.S. company, like, say, Google or Microsoft or Apple derives a lot of revenues from offshore. And there's been some logic to that, but now in this, maybe not so brave new world that we're in, it's a very scary new world, where there could be easily retaliation against these big multinational U.S. companies, that line of reasoning may no longer be valid. And that's really a radical change. Now, so far, it hasn't gotten very vicious yet, but it could. I mean, certainly what China is doing is a very aggressive reaction to our measures. And I just don't think trade wars are a good thing. I mean, I get why we're doing what we're doing, but it's it's a major risk, and the stock market is not priced like it's a major risk.
Yeah. Yeah, I mean, that's a terrific point. And I would just suggest too that, within these European, negotiations, not just China, I think Europe has suggested that they could potentially tax the digital revenues of Magnificent Seven companies operating in Europe, which would be, a problem for those companies to, basically tariff their business in Europe.
If you gentlemen are open to wrapping this up on a political note, we do have one from Barkley.
Hi, Barkley.
As Trump continues his rant, what is the probability he next issues an executive order asking the SEC to kick Chinese companies out of our capital markets as his next terrified escalation? Could such an order stick?
Well, that's certainly the financial equivalent of going nuclear. I mean, I guess it's within the realm of possibility, but it just kind of highlights what I said, that we're in a very volatile and high risk environment. But what do you think, Jesse?
I think from the sounds of things right now, it sounds like Trump wants to open negotiations with the Chinese. They want a deal, but that is certainly a risk. And I think, when you go down, the road of trade wars, you risk seeing things like capital controls and these types of things enacted. And so I think that might be a bigger risk than than people maybe anticipate today. I've been really bullish on the Chinese internet stocks for the past couple of years because they just got so cheap, and then after the DeepSeek breakthrough, they had a really nice run to the upside. But I recently took my positions off there because of I think we're now in kind of in terms of the AI capex cycle, we're probably entering a digestion phase that might be bearish for all the companies that are focused on AI right now. There's also these risks of the trade war growing into something bigger, and in the short run, that trade might have been played out. Didn't make quite as much as I would have liked to on that, but I do think, as much as it's kind of difficult to think about capital controls, it's something that, should a trade war escalate, it could come to that.
All right, so I think we have a wrap.
That's it.
Jesse,
Unless
sorry for
anyone
keeping you on so long.
Yep.
That was fun.
Thank you very, very much for your time, Jesse, and all your great thoughts.